All right, we're going to go over one of my favorite strategies with Luxago, and that is the price action concepts fair value gap strategy. Now, when it comes to price action concepts, remember that this is a market structure plus a institutional level trade. So it's taking smart money concepts, mixing it with price action, and what I do is I mix it with market structure as a whole. So when it comes to trading price actions concepts indicator from Luxalgo, there's a couple things that you want to be able to consider. So first, you always want to consider what the actual market structure trend is. For those who don't know, market structure is basically where the markets in an uptrend will have higher highs followed by higher lows, and in a downtrend it'll have lower highs followed by lower lows. So that's what your market structure basically consists of when it comes to trading. Now, with the market structure of Euro Japanese Yen, which is the pair we'll be using for the strategy, it recently had a climax from a downtrend perspective, and now it's been climbing back up. With the market structure taking that into account, my lower high would have been here based on the 1 hour. Now you can go to other time frames and have a different analysis of market structure, but based on the 1 hour, this high right here would be my point. So that was roughly a 680 swing, 680 pip swing on market structure from that last climax down. And then what began to happen is that the market started to climb up. So you had this high here followed by this higher low, and then after this high you had a higher high. Now for me, because it's significant enough of a move, I will consider this a change in structure. So I am looking for a buy in this scenario because you had a real significant move to the upside, a retracement, and another significant move to the upside that beats out the high of the last move. So now I'm looking at, okay, now we're looking for buys. Now what happens when you're looking at analysis and looking at price in this turn is that now I'm looking for the institutional moves, whether that's big jumps in prices, order blocks, change of character, breaks of structure, different things that signify that there is institutional interest in an area or institutional movement in an area. So for this particular move, now we have that higher high. So now I'm looking at a couple things at this point in time. I'm looking at this imbalance that was created here. I'm also looking at this last downward candle before the big move as my 2 points of interest. So you had the last little inducement of sellers thinking that it was going to continue down in this downtrend from earlier to trap sellers in order to make the move up. That's the institutional move to me. So now I have 2 areas. What I love about the price action concepts, normally I would have to take a Fibonacci, and what I like to do with imbalances or big gaps in price is take a Fibonacci and measure out the halfway point and the 71% point. The 71% point is a value that I've learned that from a Fibonacci standpoint, markets push past the 61.8 to kind of do a miniature stop loss at the 71 level. So instead of me looking at the 61.8, I look at the 71 level. So with that being said, my old school method would be to have that be a trade zone. What I love about the price action concepts is that it would give you automatically the 50% here from the original inducement of price. So now, when I'm looking at the pair, all I have to do is wait for it to retest the line, show me some level of respect of that line, because not every price value gap is going to be respected. So respect meaning that it's not going to close below that zone for me, or even close below the imbalance lower band, that it will respect it and price will react off of it. So looking here, zoom in on it, you had price give you a respect here, and then say if you missed that move, it gave you a second chance by giving you a long wick here. So if you catch the first move, let's kind of get back into where we're talking about here. So if you catch the first move, you could look at something similar to this. Let's kind of even things out. So your move would be at the close of the candle. Your stop loss would be below the imbalance zone. And then what I typically go for before I even take profit, I go for about a 1.6 to 1 risk to reward ratio before I start taking profits. So, and that's my bare minimum before I take profits. So obviously it reached that in a decent amount of time. If I was to hold it multiple days, then that would have gave me a higher percentage. And it just depends. That would have been a 3 to 1 risk to reward percentage. Say you're more aggressive. Some people, and sometimes even myself, we would have a buy limit order at that 50% mark. And sometimes we put it slightly above or below, depending on if it's a buy or sell, just in case the market kind of beats us to that point and tries to move away. So if I would have did that, I would have had my stop loss below that low of the imbalance. And from here, just by having just a little bit more better positioning, I would have gotten a 3 to 1 just off of the first move back up. So that's a big difference in risk to reward. Sometimes if you're able to have your right risk parameters, you can go a little bit more aggressive on the positioning if you know what you're doing. So let's kind of look at a fresh chart and give another example. So let's zoom out. So GBP CAD had a similar synopsis as Euro JPY. You had your final climax here for people who trade patterns. You know, you had your descending wedge pattern, so whatever way you trade. I don't really trade patterns, even though sometimes you can be profitable off of patterns if you notice the right ones. But that last final high for me, that significant one, would have been there, because that was the one that came from this move. I see that price comes up to this point, beats out this high, comes back down and gives me a retest. And then there's a little consolidation here. I'm not going to think about that consolidation, so I don't really trade in a consolidated market. But then there is another high here. So now when that higher high is officially created, that's when I start to zoom in. So let's zoom into the markets right about here. That's when I start to zoom in. So now a couple things can happen, and not all the time will your trade scenarios play out perfectly like the last one, but you'll get a good idea. So just taking that analysis, I'm looking at this point here for a retest, and also that fair value gap point was right here from the Lux algo. That would have been my trade zone. Now you see that the market didn't come down to it. If you were a break and retest trader, that would have been a great trade for you. I'm not a break and retest trader. I like to look for a little bit higher points of positioning, a little bit more perfection with the positioning versus just the break and retest. I like more than just a break and retest, but I've seen people win with both. So whichever one is more comfortable for you. For me, when this high got created and I see, I have to zoom in again, I see this get printed. Now I'm looking for that trading zone here. So when I'm looking at price, I see you got this point here. I don't really have a major candle, bearish candle before the inducement. It was just the inducement that happened within kind of a consolidation range. You know, if you wanted to, you can try to look down here, but that doesn't really count because it consolidated after the inducement. So all I have is the imbalance point. So that's where I would look to trade. With it being a smaller imbalance point, and I don't have a second point of interest, I just use the bottom range of the imbalance. From there, you could have waited for a respect, so you get this strong downward candle that's not respecting the imbalance, but you can either trade it off of this doji when that doji finished, or when you had the close of this candle here. So you would have had either a position right at this close, and you could have had, for if it's a smaller one, I like to put it below the major move. So that's the candle there. I would have put it below there just to give it some little leeway, because this major candle, think of it like a shield. This is where whatever institution, whatever large player was interested in. So it's not going to typically go past that point too much, because that's where the interest was. Like if you just look at that price point by itself, and I just draw a line here, you see that there was a large close here. Then there was a large move that kind of started from that area. So that area of price is pretty, as much as a hot spot. So for me, I'll just use it as a buffer for my trade. So either I would have had a trade like this, where the top of the last high would have been a 3.5 to 1 risk to reward, or if I was being more conservative in my trading, I would have had my trade here, and the same move would have been right at that 1.8 to 1 reward to risk ratio. Both would have been great trades. Obviously, being a little bit more aggressive can sometimes pay out, but also being conservative can be more accurate as far as winning more higher percentage of your trades. And with this type of strategy, you can kind of rinse and repeat it. You see that the same thing happened here, and this is not even using the order blocks down here. This is just using the fair value gaps. Obviously, in a trade, say like this trade here, you had this order block, this imbalance here. You see price came right down to it. Say if I was trading that and I was doing the buy limit, around that area, it would have looked like this. It would have had that buy limit there. I would have used the order block as my buffer, so I would have put it right below. I like to just have something that's of interest to be a buffer, and my trade would have been 2 to 1 just off of the first move. Now obviously this trade would have been a little bit troublesome. You could have waited until it closed, and then I would have still put it below. It would have been a pretty decent sized stop loss. But you would, if you're patient, you wait it out, you still would have got your reward once it got out of that consolidation. Again, it just depends on your trading appetite. So that would have been a 2.3 to 1 reward to risk ratio. So that's how I trade with price action concepts. Let me know how this works for you. It's something that I enjoy trading. It's very simple to execute, and to me, it's very effective. So let me know how you enjoy it, and I'll see you at the next video.